Hello, everyone, and welcome to the latest LPL Market Signals. Jeff Bookbinder here with my friend and colleague, Dr. Jeffrey Roach. How are you today, sir?
Happy Monday as we're recording. Doing well.
Wonderful. Thanks for joining. Glad you're here to help us interpret the jobs report from Friday. But before we go any further, I will mention that it is January 8th, 2024, as we are recording this Monday midday. It'll be Tuesday when you all listen to this. First, we'll take a quick peek at these lovely disclosures, and then we will show you our agenda. So here it is. We're going to first start with just a recap of last week, which essentially is a bumpy start for stocks to 2024. Although nice to see some green on our screens here on midday Monday. Next, key takeaways from Friday's jobs report. It was an interesting week in terms of watching the bond market and how it reacted to the data. So we'll talk about that. In particular, interested in Jeff's take on what the jobs report means for the Fed and the Treasury market. Next, the weekly market commentary this week is on China, authored by our colleague Quincy Crosby. So we'll look at the considerable challenges for China. And certainly a lot of them geopolitical, but also economic as well. So check out that commentary on LPL.com. Great job by Dr. Crosby trying to boil down the China situation in just 1,000 words or so. And finally, it's inflation week. Probably could have said inflation week and earnings week. We get the CPI and the PPI plus the start of earnings season. So we'll give you a really brief preview, probably spend more time on earnings next week. So starting with the market recap. So, it was a disappointing week. The S&P 500 down 1.8%. That ended a 9-week win streak, which was disappointing. Also, we didn't get the Santa Claus rally, that 7-day period, 5 days at the end of the year. And then the next 2 trading days, we were down about 1%. So no Santa Claus rally. I'll show you what that means in a minute here. We saw generally just risk off across the board, right? You saw more losses for NASDAQ and the Russell 2, down about 4 and about 5 respectively. I think one theme to pull out here is that the stuff that didn't work last year is working this year and vice versa. So if you look at the sectors at the year-to-date column, you see, healthcare, one of the worst performers last year, was, up 2.1%. As of Friday year to date. And then, some of the biggest winners last year, the growth sectors. So that's your tech, your consumer discretionary, and then to some extent, communication services. Those sectors have all been down year to date. The mega cap techs generally have not worked this year. So I think that's a theme. We're not necessarily going to make the prediction that continues. In fact, today, the mega cap techs are bouncing back nicely, but it's probably going to be kind of a grind. Those growth sectors that have done so well are a little bit expensive. LPL Research does favor those sectors for the full year, but we have seen, value and maybe, again, the sort of cyclical value or defensive that didn't work last year is starting to work a little bit more this year. The only other thing I want to say here is that you're not getting a lot of benefit from going overseas so far. You've got 1 to 2% declines globally in the major indexes. There, I guess Japan has held up a little better, but generally it's been red everywhere. Turn to the bond market, and this is where I want to bring Jeff in. The bond market was down last week. I mean, I guess most of the damage maybe was done before the jobs report, but what do you think really contributed to the move higher in yields? That we had the Fed minutes, we had the ISM data, we had the jobs report. What do you attribute that move in rates to last week, Jeff?
Yeah, I think a lot of that could be attributed to the first 3 trading days of the year. I cut out the Monday, of course, which is a holiday, and Friday being a very volatile payroll day and an ISM services report day. So you had 3 days that, Tuesday, Wednesday, Thursday, perhaps it was coming off of, how the markets were continuing to interpret that confusing tone in the minutes, right? Participants are highly uncertain about the economic outlook, although you could also say the minutes were slightly hawkish. For those listeners that are also LPL advisors, they'll see in our daily market update and some of the other communications we've talked about that. So yeah, it is kind of funny, Jeff, when I look at this slide. The 5-day includes last day of last year because we only had such a short week last week. But a lot of that I think is trying to reset expectations. How aggressive will the Fed cut, and will it be somewhere in between what the Fed says they're going to do versus what the market's expecting? The markets are probably over exuberant on 2024 rate cuts, somewhere in the middle. And I think bond markets are trying to adjust to where that's going to land throughout. And we'll see more of that throughout the coming months.
Yeah, oil was up a little bit last week. That might have been part of the rate move too. It certainly ties to the stronger dollar, which weighed a little bit on international markets. So, sometimes it's hard to assign a narrative to a specific move in a short period of time. But, I think bottom line, we can't just ignore the Fed. Not quite yet. So here's the S&P 500. We came into the year pretty close to all-time highs. We had overbought conditions from a technical analysis position. That was a recipe for a rollover, and that's what we've gotten, pulling back about 2%. We think we can make a run at 5,000 this year. The high end of our target is 4,950. But it's going to be, it's not going to be a straight line, right? This dealing with the Fed and the potential for the economy to slow in 2024, that's certainly our base case. Could make for a little bit of a bumpy ride. We also have geopolitics and a U.S. election that could certainly cause some volatility. So we still are confident in that outlook, but just want to make the point that it's probably going to be bumpy, and you're going to maybe even have another attempt at an all-time high and fail in the 4,800s. The good news here is, that's not all bad news, but the good news here is that the breadth has been pretty good, Jeff. You see almost 90% at these, above these positive, very positive momentum indicators, percentage above 50-day moving average, percent above 200-day moving average. These are very, very high. That could mean that we got to roll over or pull back a little more. But again, the good news is a lot of stocks, and maybe the market's seeing this today as we're recording this on Monday, that maybe some of the weakness was a little bit overdone, and you're seeing a little bit of buying the dip in those big cap techs. What do you think?
Mm-hmm. Yeah, and I think you could also say the flip side is, you look at that top chart, which is the actual price metric. Perhaps the rally was a little bit overdone too, right? So you think about coming out of Thanksgiving, going into the beginning of December, people were saying, "Hey, holiday sales are going to be gangbusters." And it turns out, at the end of the year, you realize, well, roughly speaking, if you include both November and December, consumer spending up 3.1% nominal. And then you think, well, wait a second, inflation was somewhere around the 3%. And perhaps when you account for inflation, retail sales numbers were not as robust. So I think you could kind of look at both sides. And, I think a lot of investors are saying, well, maybe we were due for a little bit of this pullback, and but certainly nothing to be worried about, especially as you highlight when you look at the breadth of performance.
Yeah, absolutely. Something that we didn't have, all the time last year. Mm-hmm. Certainly. So I mentioned that, the Santa Claus rally period was down. It's always a little bit dangerous to look at these patterns and get too confident that they're going to play out again. But, now that Santa didn't come, we got on average a 4% return for the year instead of 10 if Santa did show up. It's just one indicator. We'll see what happens in January. I guess the first 5 days of January we're down too. We've also got the full month indicator. So, these don't always hold, but we are coming into the year kind of on shaky footing, which maybe makes our forecast for mid to high single digit returns more likely than a double digit kind of a year. We'll have to see. So let's turn to the jobs report. And Jeff, I put a couple charts in here just to show people the numbers in case they missed it from Friday. Certainly a lot of people taking vacation, maybe even some people snowed in. So we got 216,000 jobs for December. That was nicely above the 175 consensus. So pretty big upside surprise. And then the unemployment rate held steady. People thought it was going to be, or at least the consensus thought it was going to be up a tenth, and it was not. So still very, very low. So clearly the job market is healthy. And then you see the average hourly earnings maybe too healthy, right? Because this was a little hot. The consensus was looking for 0.3. We got 0.4 month over month, which translates into a 4.1% year over year increase in average hourly earnings. So, actually that's the second straight month of a little bit of an uptick. So, Jeff, what are your key takeaways here from the numbers now that I've set the stage?
Yeah, the great. These are helpful. I think the challenge, of course, is trying to read past the headlines. That's one challenge, and of course, you also have to be very careful about just 1 month readings. So a lot of market watchers do some type of 3 month average or 6 month average. When you average out those monthly gains, things are pretty steady. But the slowing trend is still there. I think it's, in the under 150, when you think about kind of some of those longer term averages, the average monthly gain, softer than the 200 plus average gain that we were just seeing, maybe a few quarters ago. I think the thing that I'm highlighting in some of the notes that we're talking to when we talk to advisors, and that is we're seeing downward revisions for the previous 2 months. That's fairly normal when the economy slows. So that's kind of consistent with that narrative. What is the Bureau of Labor Statistics doing with those previous months' numbers as more and more data come in? Just a reminder, by the way, when we talk about revisions, a lot of people start throwing conspiracy theories. Revisions just means that the government collects, the Bureau of Labor Statistics collects data first couple of weeks. They have an estimate and seasonally adjust the numbers based on, where we are in the year, right? You don't hire a lot of external painters for projects in January like you would in July. That's what we mean by seasonal adjustment. But you realize that as more and more data come in, sometimes it comes in after the initial print. Hence, there's revisions. So just wanted to put that little bit of a footnote here. So one of the additional thing I think to think about as you think about what the 2024 job market might look like, we're definitely seeing lower job openings. The opening rates are slowing. We're also seeing a little greater slowdown in private payrolls. So when you strip out government payrolls, the 216 number, by the way, when you're looking at this screen, that includes both public and private. Private payrolls, of course, matter in terms of productivity. I think we would all agree that you want to look at the productive sectors of the economy, what they're doing, and some of the services, some of the goods producing areas, et cetera, not necessarily just looking at what the government's hiring patterns are. So that's kind of the key takeaways. Labor market's cooling, slowing. That's good for the Fed, right? Because they were concerned about all the openings and not a lot of people looking for work. Also want to highlight there's a pretty significant pullback in labor force participation, meaning people that are actually in the labor force, either working or looking, meaning there's just a lot less people looking for work. That's a little concerning. Again, that's just a 1 month thing, so we got to be really careful before we build too much of a narrative around just 1 month's report. Economy slowing, and it also, key takeaway, this is something that's somewhat positive for the Fed, meaning they can make that pivot, not be too nervous about a reacceleration of inflation, even though they're starting to talk about outright rate cuts in 2024.
Yeah, and then Jeff, well, actually, before we get to another theme that I know you pulled out of the jobs report, I just want to highlight this, the 2-year movement. You actually flagged this first, right? the initial reaction to the jobs report, which, again, the average hourly earnings number was a little hot. We know the job creation number was a little hot, at least on the headline. The machines immediately sent the 2-year yield sharply higher, right? What were we up? 7 bips, 6, 7 bips immediately. Then, after people peeled back the onion, as I like to say, look what happened. That thing plummeted on Friday, right?
That's exactly right. And
446 to 432, right? 14 bips.
yeah,
That's
yeah. So
in
yeah, so Joe, Jeff, you're highlighting there, right there in the middle of the screen, January 5th. This is a 3-day intraday chart, right? You see Jan 4, Jan 5, Jan 8. And so right there in the middle of the chart is the intraday yields on the 2-year treasury. You're exactly right. Right after the 8:30 Eastern report, Eastern time, you know, just absolute massive spike. And then of course, just 2 hours later or less, you have another report saying, hey, wait, the job market in December was not as hot as that headline number suggested. And basically what happened on Friday was the Bureau of Labor Statistics released a report on December hiring, and then the ISM survey released a report on what purchasing managers in the services sectors across the country were reporting in December. Two very different, contradictory views. Hence, you see that right there in the yields. I'll just take a step back, Jeff. I think this is important for our listeners. This is one of the reasons why it's important to not only look past the headline, but also look at the bond market as you think about at building those expectations for the year. Bond market gyrations are very, very important, and maybe we could argue a little bit more important than some of the movements you see just in stock prices. So bond markets are key for building out those expectations.
Yeah, certainly now the market's had plenty of time and we're down, right? But before the report, around 4.4, now kind of in the mid 4.3s on the 2-year. So, and I just checked the Fed funds market, and the odds of a March cut are still about 67%. They've been in the 60 to 70 range here for a while. So I think, another takeaway is just that the market's view of the bond market, at least, view of the jobs situation has really not changed despite all those gyrations.
Yeah.
So here's another theme, Jeff, you pull out, which is part-time relative to full-time workers. So what does this tell us?
Yeah, it's telling us here that businesses are uncertain on the outlook in the near term, meaning uh, if they have a decision, they have a project to work on, they have a decision. Am I gonna hire someone full time to work on this project, and then whatever next project might come, I don't know what that is yet, but hey, we got a full time worker. The flip side is, hey, we got a project to work on. I have no idea what next quarter's business might look like for me, so I'm going to hire a part time worker to get something done. When you look at the latest numbers, part-time workers relative full-time is slightly above where things were in 2019. Forget what you see in that graph in 2020 and 2021 for obvious reasons. A lot of unusual things were happening in the year 2020 and the subsequent year. You want to look at relative to pre-pandemic, and I think again, just an illustration of looking past the headline. Don't get confused, right, by that initial print, like the bond market showed us. So yeah, businesses, I think, are communicating a little bit of that uncertainty, and they're preparing wisely for a slowdown. Now, the next question, Jeff, is, well, what does that mean necessarily for earnings, right? Where your world is as our chief equity guy, and I think we would both agree that businesses have been preparing for a slowdown for several years now, right? Coming out of 2022, and so perhaps as the economy slows, businesses are in pretty good shape to manage through that slowdown. But that's some of the key points wanted to highlight for our listeners on this one.
Great. Well, we'll get to earnings here again in a little bit, but let's quickly cover China here. Just got a couple of charts from the weekly commentary on LPL.com, which we recently, I guess, redesigned. So LPL.com now has a research tab, and you can get to a lot of our uh, podcast videos, commentaries, our blog. You can see that all on LPL.com. So this is up there now. The several takeaways from the report. I mean, one is just that China's really struggled economically, especially in recent years, and that has caused dramatic underperformance. So when you do a really long-term chart like this is the S&P versus the Shanghai Composite and the Hang Seng, which is certainly a China-heavy Hang Seng index. And you see here that the S&P 500, really since the middle of last decade, has just blown away these other markets, right? By, multiples of 100%. So this is, it's not a new story that China has economic challenges. It's been a significant drag on its markets, right? So you have the property, the debt problems of the property markets, right? You have shadow banking, right? Banks that are, or non-bank lending, I should say, continues to be challenged. The reopening was expected to cause inflation and drive growth. It did not do really either. So they're kind of stuck. Quincy makes the point in the piece about how President Xi at the end of the last year made his annual speech to his people, and he was really pretty downbeat, which is a little bit uncharacteristic. They also delayed their third plenum, their annual government officials powwow, which suggests that maybe there's some conflict there and they're really having a hard time figuring out what to do about their economy. They've been focused more on monetary policy, hasn't really done much tinkering around the edges. So it's just a really challenging economic environment over there. And, that probably doesn't get much easier here in the near term. We'll see. They'll probably get more aggressive with stimulus. But for now, we still think caution is prudent in emerging markets broadly as an asset class, and China, investing directly in China. By the way, sort of arbitrary regulatory moves are another reason to be a little bit careful here. A few years ago, they nationalized the for-profit sector, and now it's very unpredictable how they're doing gaming regulations, which has affected some of the big tech companies in China. Jeff, you just talked about how companies, when they invest in people, they want to have visibility and clarity and confidence, right? Well, that's really hard to have for an investor in China. However, there are a lot of other pieces in the emerging market index that look pretty good to us. So we continue to like India and Latin America. So this chart shows you, going back about 4 years, how strong the Indian and Brazilian and Mexican markets have been, right? Strong outperformance there, while the Hang Seng, we're just basically representing China with the Hang Seng market, has been terrible, right? So, I mean, we're talking about 60-70% gains in India, while Hong Kong has gone down 45, give or take. So there are still opportunities to invest in emerging markets by country. This is why active management makes so much sense to us in the emerging world. And these opportunities look really good. It's not homogenous, I think is the key. So those are some of the themes. Actually, one other thing. Taiwan election coming up next week. So whether the pro-China or pro-Beijing party wins or not will be, I think, a big determining factor in how worried the markets get about China. So we'll be watching that very, very closely. So anything to add on that topic, Jeff?
Yeah, I think we've highlighted India the last several months, actually. Just some of the fundamental improvements. And now, granted, there's still some challenges in infrastructure, for example. But some of the fundamental metrics coming out of India, just like Japan, are a couple of countries that we've thought worth highlighting for investors. But you're exactly right. Particularly in emerging markets, there is quite a lot of dispersion that investors need to be mindful of.
Yeah, absolutely. So LPL Research still underweight emerging markets, but like some pieces of it. for sure. So let's transition to the week ahead. It's a really busy week, Jeff, because the inflation data is always important. And then you get earnings season. So why don't you start with the economic calendar, and then I'll make some quick comments on earnings.
Right, right. So, the big one will be on the 11th and 12th as well, a little bit. PPI is producer price index for those wondering, but it's really all about the CPI, the consumer price index. And the overall narrative is, we're seeing convincing cooling in inflation. We're waiting to see what's happening with shelter, particularly rent and leasing prices, something we need to be watching on that report, as well as some of the services, particularly insurance. Some of those metrics are a little bit frustratingly high. But this should be, adding more convincing support that the Fed pivot is certainly the pivot that happened in December is certainly something that is a reasonable, subtle shift in policy and building expectations for when that first rate cut will be. At this point, a lot of market participants are thinking it's going to be March. Certainly not, not a dead giveaway. Perhaps things might not start as soon as March, but this will be key. Again, look at some of the services metrics as well as the shelter costs underneath that headline number that'll be reported at 8:30 Eastern time on the 11th.
Very good, Jeff. And that ties into earnings, just like the jobs report ties into earnings. So I think certainly margins are going to be important to watch, right? If we're going to beat expectations meaningfully. Right now, consensus is expecting S&P 500 earnings to grow 1% year over year in Q4. We get the big banks on Friday, so we'll start to get some information to to gauge maybe how much upside or downside we might get. The average upside is 3 historically, so that points to about 4. That seems to be a reasonable place to start. The economic environment's been pretty resilient, so that speaks to maybe nice upside. Although the economic surprise indexes have pulled back a little bit recently. So in other words, the economic data has not been beating consensus expectations by quite as frequently or by as much as it had been in Q3 when we saw 5 points of upside. So maybe that points to a little less upside, but the dollar's been weaker, so that points to maybe upside to international earnings translated back into dollars, right? And then we've also had some pretty healthy revisions from tech. In other words, there's optimism building that tech earnings will be pretty good, or tech adjacent, because some of the tech earnings are actually in other sectors. So that's a positive. But then we've seen healthcare earnings and materials earnings get slashed pretty aggressively over the last few months. So that's a little worrisome, right? So you've got, I think, headwinds and tailwinds. You mix all that together, and frankly, I'd be surprised if we did something north of 5 for earnings, but maybe that 4 to 5% year-over-year growth rate range is a reasonable place to be. Now, because estimates have been cut, the expectations for Q4 earnings were about 7% mid-year, right? So they've been cut, or actually going into Q4 at the end of Q3. So that suggests that the bar is low and can be cleared. I think actually margin expectations might be a little bit too conservative. So if we're going to get that 3-4 points of upside that we hope to get, it's probably going to be because margin estimates are a little too conservative, given we've had inflation come down. Labor markets cooled off a bit, as Jeff alluded to. That might be good for margins. So, feels to us like it's a pretty easy 2-3 points of upside, but maybe the base case should be 3 to 4 points coming in, and we'll just have to wait and see. So those are my thoughts on earnings. The big banks on Friday are going to get a lot of attention. Jeff, any closing remarks on the earnings season coming up, or should we go ahead and wrap?
Well, just a reminder for investors to consider the case that things might still be choppy, right? As you're talking about earnings expectations still adjusting. as well as economic surprise index. Don't be surprised with a little bit of that choppiness we're seeing in markets.
Yeah, historically, the economic surprise index has correlated well with earnings beats and misses. So that's why I highlighted that. And sure, it's not going to be an easy quarter, and certainly the next few quarters, as we think the economy is going to slow, and you put that together with maybe the low-hanging fruit of cost pressures has already been picked, sort of easing inflation, benefiting the cost side, cooling labor market, benefiting the cost side. Maybe it just might get a little bit tougher. We're out of the earnings recession. We'll probably grow earnings 5+% this year, but it's just not a layup. It's still a tough environment, and that's why we think this year maybe will be more of a grind, consistent with maturing bull markets. A little bit of a bumpy ride, but still, again, up mid-single digits, maybe mid to high single digits for the year. So thanks for bringing that up, Jeff. We always like to sort of connect, the fundamentals and the economic data with what we think it means for markets, of course. So we'll go ahead and wrap there. Thanks, everybody, for joining. As always, it's great to be back with you again for another edition of LPL Market Signals. I'm especially pleased that I'm able to record this in my home office and not from a hotel somewhere stuck in the nor'easter that we just had up in Boston, which I had to drive through, unfortunately, on Sunday. So with that, everybody have a wonderful week. Jeff, thanks for joining. Appreciate your insights, on the job situation, China, earnings, everything else. Always great to be with you. Have a great week, everybody, and we'll talk to you next week.